The Federal Reserve wrapping up its first policy meeting since that June 23rd all-important Brexit vote, and central bankers kept interest rates unchanged as expected by most economists, but they did acknowledge the improving economic landscape. For more, I'm joined now by Ian Weiner, the head of equity trading at WEDBUSH Securities based in Los Angeles. So Ian, what do you make of the Fed's statement, the Fed acknowledging that job gains were strong in June, and there was also some hawkish language with the Fed saying, quote, near-term risks to the economic outlook have diminished. Is that a reference to a possible rate hike in September?
I think so. I mean, I think it just further shows that the Federal Reserve is asset price dependent as opposed to data dependent, which they claim to be. So it's no surprise that with the market making new highs, that they come out and sound a little more hawkish. You haven't seen too much of a response in the bond market, and so it seems to me that people still don't believe them. But you know, they certainly came across sounding a little more hawkish and opening the door slightly for September.
But the Fed is very fragile, right? We've seen, one bad jobs report sort of derail their rate hike plans, as well as markets volatility. When we see that sort of gets the Fed on edge, and the market isn't even part of the Fed's mandate. Do you think, though, that we could be looking at a September rate hike more so than, say, a December one?
Well, tell me where the S&P is going to be, and I'll tell you what the Federal Reserve is going to do. I mean, to your point, we know what they're supposed to be doing, but if the S&P is trading at 1850 or 1900, no shot they raise rates till any time into the back half of 2017. So they're really following the market as opposed to the other way around, and it's a shame because it's very hard to decipher what they're doing other than joining the other central banks and continuing to inflate asset prices.
Yeah, and certainly a lot could go wrong from now until September or December, the next time investors think the Fed might raise rates. Now, the Fed also kept this line about how they're monitoring global financial developments in its statement. I mean, that makes sense given the Brexit vote last month, although the fallout from that seems to be pretty muted, right?
Yeah, the fallout's pretty muted. Again, as soon as there was a problem, every central bank pumped liquidity into the market. And that's what continues to be sort of the status quo. And you combine that with the fact that every fund is looking for yield, and you see the asset prices inflate. But to me, it's just more of an indication that the Fed is very closely monitoring the S&P 500 as far as they make decisions whether to raise rates or not, as opposed to truly looking at the data, which they claimed it did, because clearly unemployment's where they need it to be. Inflation's getting a little bit stronger. They themselves said that labor utilization rates are improving. So, it seems to me that the data's there. It's the market that's going to ultimately decide what they do.
All right, now we have a Bank of Japan meeting tomorrow and a Bank of England meeting next week. How does the Fed sort of inaction here set the stage for what's to come in those meetings?
Well, I mean, I think that Japan has pretty much telegraphed that they're going to do something here. They've talked about fiscal stimulus last night. Now they're going to talk about monetary stimulus. I mean, I don't know what they do, whether they buy bonds or they buy more ETFs. I mean, think about that. The Central Bank of Japan is buying ETFs in the stock market there. And so that's where we are. So I don't know what happens. The market's expecting something from them. So if they don't, then you can expect the yen to further strengthen, which would be a negative for the overall marketplace, I believe.
All right, now in the midst of this market rally, these constant record highs we're seeing, you've been on this program many times saying that, you're in cash. Do you still maintain that view?
I do, and I've missed the last, 5% rally, I think, from the couple times that we've talked. And, shame on me for missing it. But at the end of the day, it's very hard for me to, on a fundamental basis, justify where the market's trading, given that we've seen just continued expectations for global growth ratcheted down. And overall, on balance, the only people really buying stock in the marketplace are the companies themselves. So, I just can't get excited about where we are right now, trading at the multiple that we're trading at right now, to aggressively buy stocks.
All right, well, Ian, we'll be watching all of this. Ian Weiner, head of equity trading at WEDBUSH Securities. Thank you for joining us on Fed Day.
Thanks for having me.
I'm Scott Gamm, and you're watching The Street.